In this video, we're going to look at Algonquin Power, and this is a Canadian utility company. And what I do in my videos is I figure out the stock price of a company using their prior financial information, also looking at their capital structure. And then I look at the financial ratios of the company to get more information. Let's get started with the model. First thing we need is the market cap, which is 9.4 billion Canadian dollars. Everything is in Canadian dollars in this video. And the stock price is $17.84. So that's one share is $17.84. Now we're going to pull the free cash flows. And this is how we estimate the value of a company, is we forecast the future free cash flows, then discount those dollars back to today's value. And that's what I'm doing in a video here. Because free cash flow is the cash that's left over after paying all your expenses. Without free cash flow, you don't really have much of a business. Next, I'm pulling the net income, which is the profit and loss on the income statement. And then I'm going to pull revenue, which is just the sales, also on the income statement. So you can see in 2016, they had negative $88 million of free cash flow, yet positive net income. Same thing in 2017, positive net income, negative free cash flow. But if you're leaking money, that is not good. Even if you show a profit in your income statement, always look at cash flow, because if this continues for a long time, doesn't matter if your accounting tricks make it look like you're making money. If you're losing cash, you're not going to be a viable business for much longer. You can't borrow forever. If we look at the revenue, they had $800 million in 2016. It doubled to $1.6 billion, and it stayed that way for the next 2 years. But look at the net profit margin. It was 10% in 2017, and it pretty much was the same in 2018, 11%. And then it jumped to 33%. So the company did a really good job in 2019 converting its revenue to net income, because net income is the profits of the business. If you're generating so much cash and you have such little left over, that's not so great. But in 2019, they did a great job. The company paid $181 million in interest on its debt. That's on the income statement. And to figure out how much debt they have, we'll go to the balance sheet. We'll go to liability section. And then the current liability shows the current debt of $225 million. That's debt due within 12 months. And they have long-term debt of $3.6 billion. That's debt due after 12 months. They pay 4.6% interest on the debt. Since interest is tax deductible, let's get their effective tax rate. We'll go back to the income statement. The income before tax is $555 million. The income tax is $70 million. So the cost of debt is 4%. To get the cost of equity, we need the beta. That's how much the stock moves relative to the market. And this has a really low beta of 0.34. So the stock moves very little compared to the market. So the market goes up 1%. This stock should go up 0.3%. A low beta indicates a more safe investment. Let's go back to the balance sheet. We need some more information because we're going to look at the ratios later. The current assets are $513 million. Those are cash, accounts receivables, and inventory. The current liabilities are $872 million. Those are debts and payables that are due within 12 months. And let's get their equity. That's assets minus liabilities. That's $3.9 billion. Now we'll get the EBIT, earnings before interest and taxes. That's called operating income on the income statement. And that's $368 million. That's how much money the company generates from its operational business, but before it pays things like interest and taxes. So the cost of debt is 4.03%, and they have 50% of debt in a capital structure. The cost of equity is 4.93%, and we figure that out using a capital asset pricing model. And the weight of equity is 50%. So to get the weighted average cost of capital, you just combine the cost of debt and the cost of equity, and you get a WACC of 4.48%. And that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows. Then we did a terminal value, which is all years past year 4. We discounted those numbers back to today. and we get a value of the company of $16 billion. We divide that by 500 million shares, and we get an intrinsic stock price of $31. It's trading at $18, so it's trading at a 43% discount. So it's a buy according to the model. Let's see what Simply Wall Street has. They have at 28 Canadian dollars, which is pretty close to where I'm at. Both our models are saying the company is a buy. Let's look at the historical stock price. So the stock price has been driven up for many years. Then it took a little dip when coronavirus hit. It's come back up, and it looks like it's come back down. So it's sitting around $18. So investors don't feel comfortable paying $30 for this stock. Their future projections of the company feel it's more appropriate to pay $18. Let's look at the financial ratios. They have a PE of 18, which is pretty good. The average in the market is 28 and the median 16. Value investors usually look for PEs below 15. The lower the better. Price of sales is price of stock over sales per share. That's 5.8. That's a little high for my standards. Price to book is pretty good. That's price of stock over book value per share. That means investors are willing to pay $2.40 for $1 of book value. Current ratio 0.6. That's not good. They can't even cover their current liabilities. They only have 50% debt, so it's not terrible. They could take a little more debt. They have a 14% ROE. That's net income over equity. So they're not providing the greatest return to their equity holders. Interest coverage ratio of 2.0. They can cover their interest payments, but only 2 times. So they don't have much left over after interest. And they have debt of 50%. So let me know what you think of this company. Do you invest in the Toronto stock market? Thanks for watching the video.